What's going on, everybody? It's Spencer from Gray Capital. And if you are a multifamily investor, an aspiring investor, or if you just like the idea of creating passive income and generational wealth by investing in multifamily assets, well, luckily you are in the right place. Doing another episode of the Gray Report, doing a Gray Report newsletter roundup and recap of everything important that happened in the multifamily industry, real estate, and the economy, breaking down the latest research reports, news articles, blogs, and opinions, all the stuff that you really need to know to stay up to date and make the right decisions as an investor in real estate. Once again, we're going to be bringing on Dr. Matt Bosnagel, the Director of Communications and Marketing here at Gray Capital. Matt really kind of leads the charge in putting the newsletter together, really kind of managing the Gray Report website, all of which, if you are not signed up for or you're not subscribing to, you need to do, really right away. So, if you want to sign up for the newsletter, just first, you just go hop on over to graycapitalllc.com, click sign up for our free newsletter. And, that way you can get this report sent to your inbox every single Thursday at 8:30 a.m. I guarantee that you will benefit from it. You'll appreciate it. And if you want to stay up to date between Thursdays, just hop on over to grayreport.com. We've got tons of awesome articles. Again, research reports that don't get just sent out. It's kind of hard to find them sometimes. We do the digging. We've got a whole team dedicated to it. And there's also videos, podcasts, all kinds of stuff. So hop on over to grayreport.com after you've signed up for the Gray Report newsletter. All right, so let's just get into the Gray Report newsletter. Everything that was, packed full in this great edition, Thursday, July 22nd, 2021. Matt, thanks again for taking the time, being on here, breaking everything down. How's your Thursday going?
Pretty good. Hard at work and feeling great.
There we go. Feeling good. Okay, Gray Report, challenge and stability. It's people can't decide if we're just this is the best market ever, or just get ready to look for the lifeboats. People certainly have short-term memories, but challenge and stability. Matt, what's going on? What's your take of the market this week?
Yeah, this may not make sense right away, but I'm gonna say it anyways, and we can just edit it out if I sound confusing. Gravity exists, and that's okay. There have been some worry these past couple of weeks that the economy has already peaked, that the days of roaring rapid growth are behind us. But I think that, again, gravity can be a good thing. I think that it would be a bigger problem if prices were flying off into space without any kind of control. Lumber prices fell dramatically last week, and this week they're fairly stable. So we're seeing more stability, I think, and predictability now as home prices are meeting some resistance, and in the CRE markets, multifamily and industrial prices continue their excellent performance. The office market is actually buoyed by the growing return to the workplace, and retail is recovering well and showing some flexibility. There are still challenges with the Delta variant, especially with sectors like office and retail. It's not a situation where any property you pick will be a winner, but there's hard work and a lot of thought gone into the process of adapting to changing lifestyles. And I think that it's a good sign. For sure.
Yeah, I think that's a really good point. And anything kind of changes, people get a little bit nervous about. But I think it's a really good point that, this is probably healthy. We don't want to see just growth that we can't sustain. We need some kind of normal rates of growth. And like we've talked about in the past, prior to the pandemic, we had pretty slow growth. Not just a factor of kind of demographics and being a very developed country. And, why would we believe that we were just going to be on, a never-ending roller coaster that kind of keeps going up? So I think we need a little bit of sanity and normalcy. And as you said, there is some gravity. And I don't know if that was a Jeff Bezos Blue Origin reference. They went up, came right back down.
That's what I was about to say. As these rockets escape from the power of Earth's gravity, the economy should be grateful, really, that there are some laws and some predictability.
Yeah.
But yeah.
Yeah, no, that all makes sense. Yeah, exactly. We want some kind of normalcy. People are saying, "What's the new normal?" And who knows what it's going to look like? I don't know if it's going to look that different from pre-pandemic. Certainly, then some things are going to change, but we'll see. Okay, let's just get real quick into snapshot of what's going on in the broader markets, kind of rates and markets. The U.S. 10-year Treasury yield. This could be a whole topic in itself. Man, dipping down 1.23, getting very, very low compared to where it was, several weeks ago. We were in that 130 to 140 range, 1.4 to 1.3, 1.4. We're all the way up to 1.75 at one point, down to 1.23. That gives a lot of questions, just like we're talking about. Okay, maybe inflation isn't as getting as crazy as we thought. Maybe we're not going to see that crazy hyperinflation. Maybe it's still going to be elevated. I mean, I still think the break-even 5-year inflation is like 5.6% or something. So still seeing elevated levels, but maybe it'll be more transitory. I don't know. But the bond market has a lot of people just scratching their head. Why is the 10-year only at 123 basis points? It'll be very interesting to watch. I do know, as we've mentioned, we'll see on some of these rates later on, it's made financing even more attractive. So getting to that 30-day LIBOR, basically unchanged, 0.09%. SOFR, 0.05. Again, you're essentially just paying your spread, a couple more bips on top. Man, the spread between the 10-year Treasuries and the 2-year Treasuries, though, that spread has tightened only at 108 basis points. It's much tighter than it was. That spread really expanded when rates are rising up to the 10-year got up to 175 basis points, where the lower, shorter maturity bonds, they had stayed pretty low. Looking at apartment financing rates, HUD 223F, we got a quote at 2%, which is, I think, a little controversial number. I've spoken to several lenders about that 2% number when that came across our desk a couple of days ago. Because I think that's a very kind of new rate. I've still seen a lot of the F loans kind of being priced in kind of more the 2.3, which we had reported on last week, and more in the 2.2 range. You've also heard, anecdotally, there aren't a lot of buyers for these bonds because they sell these securities out. There's not a lot of interest when the rates, I guess, is at 2%. There's kind of a line, kind of that 2.2 level. But if the Treasury, and really that Treasury is kind of that floor, because if why not just buy Treasury that's going to be putting off 1.2, 1.3. Why would these two for a real estate loan or a bond? There's more risk than a 10-year Treasury. Relative low risk, but 10-year Treasury is supposed to be it's called the risk-free rate. So you need to get some risk premium, and so but 2%. If anyone's doing any deals, let us know at that 2% range. That is awesome. We're getting ready to lock in a couple HUD loans. If we can get anywhere close to that, I will tell you we're locking away below what we thought we would be able to. HUD 221D4 also come down 2.75%. Fannie and Freddie more or less unchanged, although I've seen the rates come down even more than this. Again, I think these are 10-year terms, fixed rate. I think you might be able to do a little bit better this depending on your lender, the type of deal, whether you're getting a mission rate or non-mission rate, but still very attractive. S&P 500, this week there had some little volatility in the stock market. Delta variant has given people a lot to think about, as well as these lower bond yields. People are saying, what's going on? Is Delta variant going to slow things down, slow in the economy, which we've got a couple articles about later. And just before, I guess, before we get too much into the markets, and I skipped over this, but the Wall Street Journal had a really interesting article, and this is on the newsletter. I'm not going to get into it too much, but bond rally undercuts inflation fears. And Matt, to your point, it's, are we really more in this kind of a Goldilocks era? Because if you have people on one side saying hyperinflation, non-transitory, crazy, another side saying transitory, slow growth, okay, well, maybe it's something somewhere in the middle, maybe. Hope so. Kind of a little bit of a Goldilocks situation. It kind of seems like that for multifamily, at least right now. We'll see. So I would check out this Wall Street Journal article if you haven't already. So we mentioned S&P 500, $4,358. iShares residential ETF kind of keeps clipping up at a nice pace. Right now at $89 a share. And again, you can track, all of these rates over at grayreport.com. You see res right there. It stepped down a little bit since, I guess, this was reported on early this morning. Just kind of see the day chart, a little bit of a dip. That 1 month chart, it's been looking pretty good. 3 month, pretty steady trajectory. Now spot price for gold, a little bit lower, $17.98 per ounce. The steel index, 1,700 per piece of steel, and random length futures for lumber. Yes, significantly down from the highs of $584.50 for a random length piece of lumber. Crude's come down a little bit off the highs, $69.98. Bitcoin crossed that 30,000 mark, dipped below it. But now we're back up to 32,000 for Bitcoin. Ethereum below the $2,000 mark at $1,989 per ETH. Matt, any thoughts or comments on any of these rates, markets, kind of bonds?
Yeah, if you heard me gasp, that's
Yeah.
because I clicked on the lumber link, and it's risen a little bit from
I was going to say,
that.
yeah. So where was it? Let's take a look, just real quick, kind of where, what's been going on with lumber. Not that the lumber is the end all be all, but yeah, I was going to say, yeah. So it's just in the past week we've seen another jump in really the last today.
Yeah, it was just from last night. This is bounced back up.
Up 11%. And maybe this is just, I don't know, just the volatility, because I believe the VIX is elevated. So so let's take a look at this chart of lumber. Yeah, Matt, this is fascinating. Really, at just kind of end of day yesterday, we started seeing this spike. And we went all the way. We were at kind of the $534 range. Between 550, 540, we've gone up $100. Essentially overnight, and I think that's interesting. I'm not exactly sure what the cause of that is.
If you look at the
train story, as they say.
Yeah, if you look at the month long, you can kind of see of the past week, see that it's just like a little hill. So I don't know where it's going to come back to, but it definitely seems like it's still being negotiated. I don't see it coming back to its previous heights, but I think this is good. This is a healthy market. That means people are buying more, and they're actually acting on the lower prices. And I think that part of the lower prices were due to these labor conditions and supply chain problems. So as those ease, I'm still fairly confident that the price will get to be a reasonable level. I still think it's just going to take some time, maybe.
Well, I think that's the question. What is a reasonable level these days?
Yeah.
I think everyone's just trying to make adjustments and make the best out of it, but it can be tough. Okay, especially if you're developing, how do you plan for this? Swings like this, it's pretty hard to put a pro forma together. Okay, let's get into the kind of the meat and potatoes of the report, all the good stuff. And again, similar to previous editions of the report, incredible amount of growth in the multifamily industry right now. I mean, unprecedented amount of growth, just full stop. And so first, Matt, this Yardi Matrix report from June 2021, we're basically, you can see this graph on the report, incredible lift in rents from the average rent. So let's just pop right into the report. There's a lot of good pieces, but what were some of your key takeaways, Matt?
Yeah, I think that it's a good report. That's why I started with it, as it kind of grounds the entire atmosphere that we're really in this month. Multifamily rents rose a whopping 6.3%. Now that's a quote. Year over year, and single family rentals grew 11% too. So there's lots of growth in that area. There are many sources of fuel for this hot market: burgeoning economic growth, high home prices, greater household savings, and government stimulus, just to name a few. Interestingly, the markets at the top for June were not gateway markets that may have the most room for improvement. Miami's in there, but New York and LA are not exactly at the top. They're down a little bit. So there's still some work to be done in terms of rent growth. I think for the gateway markets, I don't think that they're going to have an easy spring back as much as maybe have been predicted. And we've kind of seen it maybe month over month, but year over year, They still got work to do. Tampa's doing great as always. There was a report a couple months back that showed Tampa in all sectors, really, commercial or retail, and industrial and multifamily. It's just been doing fantastic.
Yeah, a lot of so many folks moving to Florida. Definitely driving that demand. I just hope that the red tide situation they've got out there, thinking that figured out. Pretty sad situation for the kind of Tampa Bay area. But a lot of markets we track, doing well. I think Indianapolis, being well above the national average by all these metrics, and Phoenix just kind of knocking it out of the park. So that's fascinating. There's a couple of other pieces on this in this report that I found to be pretty interesting. One that they get into unemployment growth, and they also already hit for the first time. They're now tracking single family rentals, which I think is important, especially that kind of the build to rent trend is becoming more and more talked about, more and more popular. And this again is important to us because it's markets we invest in. And Indianapolis year over year occupancy change is double than any other market in the U.S. And this kind of dovetails. And I don't want to get too far ahead of ourselves if there's anything else in this report, because it's a great report. We could spend the whole time, our whole episode just on this report. But that's really kind of getting into this idea of that we've seen all these luxury suburban properties, A-class properties, especially in Indianapolis, seeing incredible amount of rent growth. It's because that single family market is just so tight. If you can't find a single family rental, you're looking for a rental opportunity, you're gonna have to go to a luxury apartment. And that really kind of just also lines up with this report from Greg Willett at RealPage. Is just the product class apartment performance results may vary, but A class have been really, they've got a lot of momentum. And which was interesting because everyone was expecting Class C workforce housing to really suffer during the pandemic, and actually in people were expecting Class A to do pretty well. The opposite happened. Class C workforce housing, because all the government stimulus really kind of buoyed that Class C market. You didn't really see any had major issues. You saw very, very tight occupancy, and you saw some modest rent growth. The Class A segment, not a lot of people were moving around. And I think that got reduced by the fact that no one was really raising rents, and all of the new construction were having a hard time leasing up. So you didn't, so much of the rent growth in the Class A is driven by new lease ups, and they're setting the top of the market. And so that brings the average up considerably. They weren't seeing that happen during COVID because no one was moving, but now people are moving. I mean, household formation is at a multi-decade high. There's so much demand, and now people are going into these Class A properties. They've got more savings than they've ever had, before, and they may have gotten a salary increase. Maybe they've changed jobs and they're making more money. They can afford a little bit more, and they can pay a little bit more to be where they want and have all the amenities. So I think all of this is just driving this Class A rent growth. So it's fascinating.
Yeah, I always I think that when we started hearing those stories last year about the K-shaped recovery, I think that multifamily probably benefited from being a little bit more deliberate and being a little bit more thoughtful about the decisions that they could make in terms of investment, because it didn't really pan out the way that people said. And it was much more really predictable. The economy recovered, and so the Class A apartments recovered along with it. And people had more money when the economy really took off this year, 2021. And they didn't maybe in 2020. It seems a lot more common sense. And I think that your explanation provides maybe more compelling details, but just on the face of it, it seems like it tracks the economy's performance a little bit more directly than some kind of like interesting twist or kind of catchy narrative. But also notable is that all of those classes have great occupancies in the 96s. So I think that this, now that the recovery is really and truly taken off, we're still going to see some really great performance now that people can kind of afford the nicer apartments.
Yeah. So
especially in places like Indianapolis.
Exactly. So no, absolutely. And so I think that's a good point. Just going through kind of these, it's interesting. Average occupancies and that kind of 96 across the board. That was 94, 95. We're up closer to 96, plus, and then, 7.4 for Class A, 7% for Class B, and then 3%, and, for C class units. That's pretty incredible. And, it's a little bit lower in the Class C units, but, a lot of those, maintained or had rent growth last year during COVID a little bit. And you have to also imagine that, you may have even seen rent declines in especially the Class A market. And so they, they brought the rents down, and now they're raising them. So it's, it's a larger, again, it's that base effect. If they lowered them down, it's a larger increase. That's not the case across the board, but I think there could be a little bit of that
Well, in
going
that
on.
article on Indianapolis, it shows that line graph, and you see those lines are crisscrossing all over the place. There were times when Class A was shrinking in June and July of last year, and
Yep.
then it's really come up so steep now. But it's at any one time it could have been Class C is the strongest or B, and now finally it's really been Class A's time to shine.
Yeah. Yeah, I think, and that's a good point. That there's just demand across the spectrum, across the income spectrum, and this is why when we talk to investors and we're looking at our own portfolios, you want to have diversification, not just geographic, but income, demographic diversification. So you want to have some Class B, some C, and some A. Now you can kind of weigh to your preference, because different classes of multifamily have different attributes, and certain deals have different features in terms of cash flow or appreciation, how all that's weighted. But if you kind of have a mix of A, B, and C, you're going to get a good average kind of during different types of economic environments. And so another thing that I thought was incredibly interesting, again, this has come back into Indianapolis, is because the downtown rent growth, downtown's still been flat, really negative. But if you look at the Class A properties in a lot of these suburban markets, I do a double take, because we're nearly 25% in some areas. Including areas that we're looking at deals in, which is exciting. I mean, Greenwood, Johnson County, Southwest Indianapolis, and West Indianapolis are all kind of what is it, 22.5% range.
Super
Absolutely
high.
incredible. It's breaking the scales. So again, downtown still a little lackluster. Maybe I think that's a good point to transition a little bit. And there's this article from Biz Now about Atlanta is fast outgrowing its housing market, jeopardizing its competitive edge. Is this another case of kind of just it being difficult to manage suburban sprawl and managing kind of that urban planning and having so much growth that it's just hard to stay on top of it? Matt, what were some of your key takeaways?
I am not that good of a Sim City player,
Oh, well, that's where we
but
differ. Let's go. City
but
Skylines, what are we talking?
I will take your word for it. But it does seem like there could have been better planning in Atlanta. I don't think it takes an expert an expert civil engineer to real or urban planner, that is, to map out something better. I think that this is an interesting study of a large and growing market. Atlanta is still growing, but the problem is this suburban sprawl and the spacing between everything is making things very inefficient. And I know that we've talked about we talked about the inefficiencies of having multifamily properties that are in different areas, maybe in the state. And if you had a small, and it's hard to manage if they're very small. But
Yeah.
the denser things are, the more closely packed together things are, it's far easier to manage. This is just in the multifamily industry, but then there's a slew of other effects. It's commuting times, traffic, and it means that companies are having trouble, kind of getting workers, and so there's just a whole host of negative effects that are associated with this sprawl, and it's making it kind of difficult to increase the supply of housing in Atlanta without some risk.
Yeah.
So it just seems like it's beginning to strain from its growth.
Yeah. And there's so much growth. I think they'll figure it out. One thing that we look at is some markets can be growing at really incredible at an incredible pace. But one thing you want to check on is so you can have great demand, but you have to make sure you're not putting too much supply into that market that can overshoot that demand. And one way that we like to look at that is by the completions as a percentage of total stock, going back to this Yardi report from June. And so this is, you build, let's say there's 100 apartment units and you build one more unit, well, that's 1% of stock. So if it's how much more compared to what already exists are they they completed. Atlanta, I think so 2.9 is basically 3%. I don't think that's crazy. I mean, Austin's at 4.4%, Charlotte's at 4.3. But you see this, and that's where sometimes you can have great growth, but if you build too much too soon, you can just overextend a little bit and try to find a little bit better balance where supply is going to be a little bit constrained. It's again, I keep coming back to Indianapolis, 1.3%. That's a pretty healthy number. Honestly, Sacramento looks like it's kind of the best balance, 12.6% rent growth with 1% completions as a total of stock. But the problem with Sacramento is California, and I'm not going to California to invest in real estate, even though Sacramento and Inland Empire are some of the, arguably some of the better fundamentals, multifamily fundamentals to invest in, but politically, from a tax perspective, tax regime, political environment, for us it's a no go.
Yeah, it's interesting. The Atlanta article didn't note that housing prices there are increasing dramatically, but it is just hard to see, with something that spread out. And this is just intuitively, it seems like it would be harder to make a bet on where to put things. And if housing prices are increasing, you'd think you'd want that extra density. So it's difficult to see where, there's just increased risk if you have more places to put things rather than if it's more densely packed in a smaller area.
I think they're saying anywhere in the area, it's in the region. We'll build it. They'll come.
Yeah.
So far, it's worked. So this comes back to cost of construction, lumber, how did it actually affecting the industry? And I think we've been kind of looking for this. We've been asking this question. We kind of have more or less of an answer. Globe Street saying, rising lumber prices adds $92 per month to apartment rents, and they're basically they're backing into this number. So for apartments that have been being built between April 17, 2020 and July 8th, 2020, what a apartment tenant would pay, not that they are paying, but would pay based on the new costs, they're going to be $92 per month more, and that's going to add basically $10,000 per unit to the market value of a new rental unit, according to a new report by the National Association of Home Builders. So I thought that was a pretty interesting, piece. Basically, tack on $100 and $10,000 per unit to all new construction, which kind of filters its way through the rest of the asset classes.
And I think that this really it puts a pin in the discussion that we were having yesterday about lumber prices, and I took a look at that date specifically because that doesn't really it does not isolate the period of high prices. There's a full year in 2020 where prices were not going crazy.
They're elevated, but they weren't insane.
Yeah. So I'm wondering if it was more of a finite period, if it was a smaller snapshot, what that would look like. But I still think that this is really good evidence. It's a really good connection. It puts things into strong perspective. And it's nice to have a number behind it. The big question that I'm thinking is, what is the lag time between lumber prices and rent increases? And I understand that this is more theoretical, but at what point and I don't think it's happened yet, and I don't think it'll happen, maybe it'll be another half a year or another full year until we really see the actual material effect on rent.
Well, it's tough to know because just like what we just looked at, rents are up, so is that being already priced in, or is this $100 on top of $100 on top of, the call it $50 to $100 rent increases that we've seen across the country?
That's
$100.
true.
So is it a $200 total, rent move? Or is this, it's at one move and it's just priced in already? So
that's a good point. They could be, the new apartments coming online now, they probably didn't have crazy materials costs, but they're still reaping the benefits, and then ongoing construction may just be a more realistic margin.
Yeah, I think that makes sense. Okay, I think we would be amiss if we didn't talk about the Delta variant, COVID, back in the headlines. Took the stock market for a little bit of a ride. It was a Monday or Tuesday. I think it was Tuesday. And people are concerned this Delta variant, especially for unvaccinated folks. So if you're not vaccinated, maybe think about it. Um,
Yeah, this is a good
how's this? Yeah,
reminder.
what do we do about
Sorry.
this? Are we? Yeah, well, I mean, it's like we're past COVID. All of a sudden, it seems like we should be taking it pretty seriously again. But
Yeah.
I'm not a doctor or scientist, Matt. You are a
Well,
doctor, I
and
think.
yeah, but
In
not
my
that
mind.
kind of doctor.
Yeah.
This is a good reminder, I think, that there are still challenges, and it's a little bit sobering. It's part of the reason, really. I think that we're not this kind of ecstatic enthusiasm. We're still in recovery mode, somewhat. There are areas that need to be improved on, and the continued spread of the virus that has, that has caused this crisis that's still present. I think that it does not pose as great a risk to people who are vaccinated, especially even if there are breakthrough infections. I've heard that they are mild, but still, even their children can't get vaccinated yet, and there's a sizable population of adult eligible to be vaccinated that are not vaccinated. So we don't want to lose any more people than we have to, and it's going to be interesting to see what the spread is going to be like, how this affects businesses, and then how that kind of trickles down uh, to our industry, to the CRE markets. To that point, I think that there was a trio of Marcus and Millichap reports, and the upshot basically to all of them are, if there are challenges like in office and in retail shops, that they're doing a very good job of adapting to things. Maybe a shop becomes a medical office building, or an education center, and maybe the office property is taking on shorter term leases while employers kind of figure out the balance. But
Yeah.
there is some reaction, and this is the kind of work that will be done. And it really, effectively, it means it's not great boom times, but it is a situation where hard work will pay off.
Yeah. Yeah, I'm not really as concerned about the multifamily industry. I mean, we got
Yeah,
through
yeah. I did.
unscathed, but if you think about, I'm more concerned about like those businesses that are just getting back going, like the restaurants
Yeah.
who can't, are paying more for labor, can't even find anybody to work. They need some serious profit to kind of make up from last year, and if they get hit again, I could see that being a death blow
Yeah.
to a
Yeah.
lot of small businesses, which certainly not be good for the economy. So I mean, I guess that's the biggest concern.
Right now they're coming
There,
up for air, and just to be pushed down again would be.
exactly. Now, some markets, I think in California, maybe on the West Coast, there's some mask mandates that have gone into place. I don't think there's been any shutdowns that I've heard of, but just more, they've put in some more mask mandates. I think a lot of the part of the country, it's probably not going to happen. I think a lot of people it would have to get very bad. And it's not, I mean, I think like we're back to the levels that we had, COVID levels we had in like May, I want to say. So it's not like we're back to, the apps, we're nowhere close to the peak. So I think that I don't want to say it's being overblown, because I think it's worth paying attention to. I think it's important. Want everyone to be, taking precautions, being healthy, but I think that we're going to get through this. More people are going to get vaccinated, or people are going to get it, and then they're going to be sort of, immune to it to a degree if they don't die. Which I don't think that many people are. I mean, some people are dying, it's serious, but again,
I think if anything, this should be an argument for, another tick in the balance of getting vaccinated.
Yeah, just don't worry about it. And like, I'm not. You've done, do your research on Facebook all you want, but like, you're not a doctor.
People may have reasons to not get vaccinated,
Yeah,
but I think the
sure.
spread of the Delta variant is a strong argument in favor of getting vaccinated if you have not already.
I think so too. But I will say, if you are afraid to go down to a downtown, an urban core, because you're afraid of violence, or like there's a protest that you're going to get wrapped up into, but you aren't taking the vaccine because you're willing to take risks. Well, those two things don't line up. You're either willing to take risks, go downtown, be consistent, or get the vaccine, and and don't go downtown. I'll tell you, when downtowns they're safe. We're downtown every single day. It's fine. And there's just one thing that rubs me the wrong way is, this intellectual or ideological, inconsistencies. And, it's like freedom isn't free, and freedom isn't safe. We don't have a free country
Yeah.
to make the safest country. And, you should be free to choose what you want to do. Don't be an idiot. And, like, I'm the most freedom loving person you're going to be able to find, but like, it's come on, it's sometime you have to
Well, and
be a little practical here.
this may seem pithy and overly philosophical, but in a recovery, it seems like those who are willing to take those risks and have faith in their continued success and the continued success of the economy, you got to have that. You got to be able to willing to take that educated risk. Those are the people that are going to float to the
Yeah.
top.
Yeah.
And if you sit back and are worried, then you're not going to enjoy the great success that the economy is experiencing right now.
100%. We take risks every single day. It's all about how we can perceive the risks, mitigate it, understand it. It's not, you don't get anywhere really by avoiding risk. It's how you handle it and mitigate the risk.
Yeah.
So I think that's a really, really good point. And one way to do that is by just, getting the vaccine. It seems pretty easy. I have not like died, or I don't have, I have regular amount of fingers and toes. So
the microchips are really helping my brain power.
Yeah, the microchips are sweet. Like it's like, I'll take a microchip. You want a mic? Okay. Okay. Anyway, so any closing remarks, Matt? I mean, this is one of probably the most exciting period of kind of the economy, my investing career. This is the most exciting time right now. I'm like so excited for the deals that we did last year, because like they're just rocket ship Jeff Bezos into space. Deals that we're seeing right now, we're like under contract for, under LOI, and they're like, we're getting calls. They're saying, oh, we've already raised, market rents, we're up $50 a month, $100 a month. And we're like, wait a second, we are trying to hit that, in a year and a half from now. We're exceeding our pro formas before we've even closed, haven't even had to do anything, because things are moving so fast. But you have to be participating, you have to be in the market, you have to be doing deals. You can't wait until 2 years from now. Not that it might not be a good market 2 years from now. I just, I don't know. The growth is happening now. And like you said, gravity exists. We're not going to see incredible growth forever. So, if we can lock in while the growth is happening, the window is going to be closing. That's what thesis, still makes sense, but we're going to get back into this moderately slow growth at some point. Let's try to harness, everything we can while we're seeing this incredible growth. Just let farmers, like, when it's rain, you put the buckets out. When it's a good harvest, you have to. It's like the time is now, because you have down years, you have years when things are slow and they're not great. You've got the opportunity. I mean, because I was in the hops industry.
This is the time.
This is the time. I was in the agriculture industry, dealt with farmers, and like, man, when prices are high, it's like you do everything you can to take advantage of that, because it's going to go the opposite way sometime. Now, that was a much more volatile industry than real estate and multifamily, but the time is now to take advantage, harvest these gains and this opportunity. And there's the risk, 100%. There's risk in everything. If you get into the fundamentals, the risk of multifamily, if you're doing the right way with the right operator, with the right execution, that risk can be mitigated in a lot of different ways. So your risk is like, okay, I might not get it. My risk is maybe I'm going to get the same return as the S&P 500. But, there's risk of risking, 100% your capital. Absolutely. Bad operator, things can happen. But man, I can't find a better risk return balance than multifamily. And now it's incredibly exciting. Because again, the downside is like, okay, you don't get the growth. Okay, it's a lower moderate, it's a lower and moderate return. You do get a fraction of the growth. It's like our underwriting is like awesome. So we're getting this growth. At the same time, interest rates are so low. It's nuts. The spread, it's incredible. So even with low cap rates, we're able to make deals work. This isn't an offer to invest in anything or investment advice, but exciting times. All right. Well, we're going way over. Matt, thanks again for being on the Gray Report. Great episode once again, really breaking down and very exciting times. And again, if you'd like to receive the Gray Report newsletter delivered to your inbox every Thursday morning, one way to do it. You can hop on over to graycapitalllc.com/newsletter, or just go to graycapital.com and click on the button. But if you go to graycapitalllc.com/newsletter, you see a little video of me talking about it, but really just all we need is your email. Pop your email in. We'd love to get your name. My name is Spencer Gray. It's a pleasure to meet you. You sign up. But again, if you would like to start taking advantage of some of these opportunities, working on deals right now, sign up for the newsletter, then click the next button, join the Great Capital Investment Club. A couple more questions, not much, but we want to get to know you, want to understand your goals and your objectives, especially if you're a credit investor. Sign up for the club so you can get the first look at all of the opportunities that Great Capital has. And in between next Thursday, bookmark greatreport.com. I know that you will get a lot of value from it. And business updated daily throughout the day. We've got multifamily news, macroeconomic news, other real estate news. You are going to be on top of it. You are going to be the one around the water cooler with the intel. Boss is going to say, if you still have a boss, be like, wow, Jeff, Joe, John, you are the guy who's reading Great Report. Very nicely done. I respect the website. It's a great resource, and you must be in the know. So that's how you stand out from the crowd. Okay. All right. Thanks, everybody. Subscribe to the YouTube channel. Check out greatcapitalllc.com, and we will catch you next week for another Great Report newsletter roundup.